Okay, Jahangir Aziz is now joining us. As promised, he's head of emerging markets, economics research and commodities at JPMorgan. Jahangir, great to have you with us here on the program. Thank you very much for your time. Are we, with what we've heard from the Fed last night, are we near the end of the hiking cycle, or did we see the last hike last night? What's your sense?
I think we're probably at the end of the hiking cycle for the time being. I think if you look at the language in the FOMC, it took away, importantly, the language that the rates have to be sufficiently restrictive. I think that was key, which means that the FOMC is reasonably comfortable where rates are at this point in time. Now, clearly, it is not a two-sided risk. They continue to talk about, if the need arises of rate hikes, they don't talk about the need arising of rate cuts. And as Powell talked about in his in his press conference, the FOMC or the staff of the Fed did not see the economy going to a point where you would require rate cuts. So I think for this year. So I think we are probably in a period of prolonged pause, and we'll need to wait and probably wait till the beginning of next year to see rate cuts taking place, provided the economy, complies with it.
Jahangir, hi, good morning. So if this is a period of prolonged pause, as you call it, what do you see the effect on other risky assets, maybe assets like equities? I mean, what has history taught us? Because, the expectation was that at some point the rate tightening cycle would end, and now it has. So what does an investor expect to see from here on?
So on U.S. equities, we have, held a view probably from around October, November of last year that the market is overvalued and the market needs correcting. But that has very little to do with the rate hiking cycle. So the rate hiking cycle, that the rates would go on a prolonged pause was part of that scenario. I think to a most extent, the view about the overvaluation of the U.S. equity market was driven by the fact that earnings would start falling because the economy would slow down. And if you look at the U.S. equity markets, let's take S&P for example. If you take away the top 10 tech stocks, most of the market is actually, going in that direction. It's the, tech stocks which is keeping the S&P 500 where it is. So I think on the equity side, we've long held a view that the market is overvalued and the market needs a correction.
All right. Hi, Mr. Aziz. Good morning. In this sort of a backdrop, what about the RBI? What are you factoring in, inward-looking data from the central bank? What do they do next? They paused. But do you think that they are done, or do you think we have a couple of more rate hikes here from the Reserve Bank of India as well?
Well, I think the Reserve Bank more or less is done, right? And I think that it is probably going to hold rates till, at least till probably deep into this year. I think the problem that the Asian central banks have, as opposed, let's say, to the Latin American central banks, is that the Asian central banks, and I'm talking about India, Indonesia, Philippines, did not raise rates as much as the Latin American central banks. So the gap between their policy rates and, let's say, the Fed funds rate is there, but it's not that much. So in the event that India or Indonesia or Philippines need to cut rates, they have some space. Don't get me wrong, but the space is very limited. In comparison to the Latin American central banks who have rates, let's take Brazil. It has rates at 13.75. It has a significant amount of space to cut rates, even if the Fed remains on hold for a prolonged period of time. So I think what really problematic of this, of Fed holding, rates at this 5.25 for a prolonged period of time, that if the need arises, then the Asian central banks can cut. I'm not saying they can't cut, but their ability to cut deep is very, very limited, unlike the Latin American or even the Central European central banks.
Jahangir, have you seen news flow with regards to another U.S. regional bank? I think
I was almost sure you were going to ask me that question.
So should we worry about that? I mean, how large is it, and what's the
Right. Sorry. Right. So I think we need to take a step back and look at this credit event, right? So all banking stress are not the same. look at this banking stress. This banking stress is happening because all of the 4 banks involved in the banking stress have had, made pretty bad decisions on their investment books. Rates went up, and these investment books basically are not worth very much. Therefore, they do not have adequate capital to continue to lend. So future credit growth coming from regional banks in the US is going to tighten. And this is a fact that we've talked about in the past. Powell himself talked about the fact that, future credit, constraints will be added headwind. But this does not, but none of the banks went down because credit quality went down. Credit quality is perfectly fine, which means that the balance sheets of the households, the balance sheets of the corporates, and if you look at disposable income of the households, if you look at the earnings so far that we have seen in this quarter of the corporates, all of them actually point to an economy which is going reasonably strong. So I think that we need to separate the fact that this is being done because of treasury actions that were taken by these banks, and not by the fact that credit quality has gone down. If credit quality has gone down, you would all be far more concerned than we should be about the credit stress that is taking place.
Yeah.
Jahangir, but a bank going down is, not going down, maybe they're required, like, for example, what we saw with First Republic. Banks are at the center of this entire thing, right?
Sure.
And trouble there spreads slowly.
Absolutely. Yeah. So you will see credit stress. You will see credit tighten. But the point, Prashant, is that you want that to happen. If you don't have that, then how will this tightening of 500 odd basis points get translated into slowing the economy? And if the economy does not slow down, then you're not going to get the kind of relief on core inflation or on wage growth that you need to get core inflation down to any comfortable level, which means that the Fed will go back to rehiking. That's the corollary to not having a credit slowdown. So we need the credit slowdown to take place. It's part and parcel of this narrative, right?
Okay, just one final question from my end before we let you go, Jahangir. Do you see a growth pickup even in the Indian markets? We're seeing it with the banks, with the earnings, some of the auto companies as well. And the RBI also went ahead and raised their GDP projections marginally to about 6.5% for FY24. Sure. But are you seeing, the trends improve on the growth front? And what are your own projections?
So we have probably at the one end of the consensus, we look at the momentum in the Indian economy rather than looking at the last year's growth as a whole. And the momentum of the economy is that it's slowed down to the 4-5 handle. And it's very difficult for us to see that from the 4-5 handle, how does it move to the 6-7 handles when the global economy, as we all talked about, is poised to slow down. And exports was one of the big drivers of last year's growth. So unless you see private investment moving up, which is showing literally no signs of doing anything and hasn't shown any signs of doing anything for the last, 6, 7, 8 years, it is very hard to see how just consumers are going to spend their way out and Indian economy is going to grow. So we are looking at a growth number in the 4-5 range rather than the 6-7 range, which is what the government and the RBI has and probably most of the market has.
Though oil is the other big factor, right? Maybe the single most important variable. It's down 10%, 2 days, and broader macro worries.
And that is so how do you interpret that, right? Do you interpret that as a good thing or a bad thing? If you look at the oil market is down because it is actually pricing in a near-term recession. That cannot possibly be good for the Indian economy, right? You're getting some relief out of oil, but you're really going to get hammered because your export growth is going to slow down. So I don't think this time around, the decline in oil prices is actually a good thing. It would be much better if oil prices stayed at those, 85, 90 levels. I think the Indian economy is used to those levels. And that would be a much better scenario for the Indian economy rather than oil suddenly dropping to the 70s and further down. Because that is portending that the oil market is actually saying, well, there's a recession. Remember, this is happening after an OPEC plus cut has been priced in already.
All right, Jahangir, we'll leave it there. Interesting conversation as always. Appreciate you joining in with that perspective. Thank you very much for being here with us. Well, we'll take a very quick break here. Our list of top stocks to watch, earnings season in full flow. Our research team will be lining up those stocks for you in just a bit from now.